Welcome to ShortView Trading. It's your morning market hit for Monday, 7th of June. What matters today and this week for traders? Well, what a fascinating market and a great demonstration that one of the few macro data points that really can change market direction on a short-term basis is the non-farm payrolls. Friday, of course, dominated by that data point, and it came in much weaker than expected, 565,000. The market was looking for something like over 600,000. And with that, we saw some pretty marked move in some of the key equity markets as a real good indication of a day's trading of how the market is one big puzzle. So weak payrolls leads to a lower US dollar and also leads to lower US bond yields. You can see US 10-year bond yields chart in front of you now, off at the bottom end of the range, down 7 basis points on Friday. And the dollar, of course, which was very strong on Thursday, giving back some of those gains on Friday. Now, naturally, the dollar rallying tends to be risk off and the dollar pulling back tends to be risk on, broadly speaking. And we saw that with markets on Friday, and particularly with the tech area of the US market, which was very strong, the Philly stocks and the NASDAQ 100 leading the charge and pulling up the S&P 500. But the key is the S&P is actually only just back at the top end of its range. So it's still within that range, and that dollar weakness we saw on Friday hasn't seen much follow through. In fact, the dollar's pretty much trod water ever since. The key question is, should we still remain short, or is Friday's price action telling us things are changing? Well, for 3 key reasons, we recommend remaining on the short side in this market, in particular in respect to trading equity index futures, S&P 500 futures, and so on. And those 3 key reasons are as follows. Firstly, markets remain very complacently priced. And indeed, there are lots of ways of showing that. You can look at the low level of the VIX. You can look at our VIX RSI, short-term market timing model. You can look at the steepness of the volatility curve, or indeed you could look at a put to call ratio as we're putting up in front of you now. And you can see there's a low level of outstanding puts. That means market participants are not protected to the downside, and therefore they're vulnerable to that downside, and therefore they would accentuate any selling that came to pass on the back of any negative sort of news flow or any trigger that got that going. Secondly, momentum still seems to us to be rolling. So yes, Friday was quite a strong day, but actually if you look at our global composite momentum model, it had a sell signal earlier in June and continues to roll over. That says to us that the momentum has faded and the momentum is increasingly rolling over to the downside. And then thirdly, look at things like Bitcoin. Bitcoin is a good indicator of where the S&P may well be going over coming weeks and days and trading sessions and so on. And as I look at Bitcoin today, it really gapped lower as we saw a number of weeks ago. And indeed, it's trod water below its 200-day moving average. So for me, that price action looks pretty precarious. It looks like it's poised for another wave lower. And therefore, I'd be pretty cautious on Bitcoin and therefore cautious on what may well come through in terms of the S&P 500 following that. So for those 3 key reasons, one would be cautious about these equity markets. We go into more detail in our daily rag each and every day, where we update all our key short-term market timing models, and we update our thoughts on markets and our 1 to 2 week recommendation on equity index futures. But clearly associated with that, there are also lots of risks. There are lots of potential triggers. This G7 corporate tax deal could well be a bit of a trigger for markets. Clearly it has some implications for how much corporate tax big companies may well pay, and therefore at some stage will need to be priced in. Over and above that, we continue to look at some of these Chinese CDS prices. Huarong is a key one that we're putting up in front of you now. These CDS prices are elevated and therefore of concern. This remains a risk. Interestingly, this week we got the Chinese lending data as well, part of the same sort of theme and risk that's out there, i.e. the idea that China might well be tightening up a little bit on its credit. So for full details on how we're playing this, please see today's daily rag available to subscribers via the website. Or if you're interested in a free trial, please click on the link below, put in your name and email address, no credit card details required, and we'll send you the daily rag for free for 7 trading sessions. Or if you like what you see, please sign up. It's $50 a month, cancelable at any time with nothing further to pay. So what are we watching this week? Well, there's a lot going on, particularly, as I mentioned just earlier, the Chinese lending data. This is the monthly social financing, monthly lending data, which is really key, comes with the money supply data as well for China. This is closely watched, one of the key indicators of where the Chinese economy is going. That's one key theme. Secondly, US headline inflation, headline and core CPI later this week. That's always watched closely. Of course, April's number was very high. The market's expecting something with a 4 handle in front of it for May. So People will be dissecting that, and that will be key potentially in the way bond yields play out as well. Over and above that, the ECB's meeting on Thursday, no change expected, but there's a press conference with Lagarde, and there may well be some tidbits coming out of that and some interesting comments from Christine Lagarde, the ECB president. So that's it from us. That's your morning market hit for Monday, 7th of June. Thank you for listening. Please do subscribe to these free videos on YouTube. Simply search under ShortView Trading and click on the subscribe button, or follow us on LinkedIn, Twitter and or Facebook. Thank you for listening. Stay safe. Trade well.